Okay, y'all. Now we are in our third video, our last chunk of direct instruction. Thank you so much for bearing with me. So let's get this over with quick. Now that you have told me what the most important question to ask when choosing a credit card or loan is, we're going to dive into how do companies determine whether or not they're going to lend you money. So this is how they determine it by your credit score. Here, I would like you to write down in your learning map which one of these definitions you like better. You have room for one or the other. You might have room for both, but pick which one. One way to think of a credit score is measuring how risky it would be for someone to loan you money. Okay? The second one would be the number determining how likely you're to pay back your debt, right? I like to think of a credit score essentially kind of like a report card almost. So let's look at the numbers of a credit score. It's a 3-digit number. High is a good thing. The bigger the number, the better. It means you'll get a better loan deal and better interest rates, lower interest rates. They're not super expensive. If you have a low credit score, that's not a good thing. It means you're high risk and typically have a higher interest rate and can't get approved for a loan. Here's kind of a graph that shows your credit score, sort of at the range. I think it's really funny that they made red good and poor bad. It's normally opposite, but whatever, right? You hang out in the middle between 640 and 700, but you really want to be 700 plus. Anything below 700 is kind of when your interest rates gets really high. And when you get below 580, you don't normally get approved for credit and your credit interest rate has gone skyrocketing. So, like I said, below 580, high interest rate, won't qualify for a loan. Between 580 and 619, bad loan terms, high interest rates. Just not a good situation for credit. 620 and 670, higher than average interest rates. When you finally get back up to the 700s, you'll qualify for most loans, but you still won't get the best deal. What you want to aim for is that 700 plus, where you can get a loan at excellent rates. You can get any loan, great rates. So try and keep it above 700. Now, what's crazy is how you handle your credit will lower or raise your score like that really quickly. So maxing out, meant to be maxing, y'all, just roll with it. Maxing out your credit cards will drop your rate. You want to make sure that you don't go above 30%. Never go above 70%. Keep that 30% limit whenever you have a credit card. And if you don't pay your bills on time, that will immediately drop your credit score. Make sure that you are paying on time regularly. If you pay on time, your credit score will continue to rise or stay where it is in a very happy place. Also, just simply being careful how much you spend and being wise what you spend your credit on. Your credit score is a very, very touchy thing. Anything you do in your credit will change it, and keeping those high numbers is really important. So, on your learning map, when you think about credit, and we think about the particular things that we talked about, remember, if you have a lower credit score, you're not paying your bills on time, and you're spending a lot of money, and you're probably not spending it on things that are helping you be productive or helping you make money. Remember, when you raise your credit score, you're paying your bills on time, you're using your credit effectively, and you're making sure that you're not maxing out your credit cards. So when you think about these things, what would be a way you would suggest to someone who wants to raise their credit score? If you were going to talk to somebody and they were saying, man, my credit score is really, really low, what's a bad habit they could be using that you would encourage them to change? What is something out of the things that we've talked about that will help them raise their credit score? I'm going to pause the video and I'm going to give you about 2 minutes, and I would like you to defend this in your learning map. Okay, so now that we've talked about credit scores, who makes them? There are 3 major companies, and their job is to simply calculate your credit score. Each of them calculates something differently, and only they know specifically how they're calculating it. But like I kind of showed you, we kind of know how it works when we look at that scale, which you have in your learning map, that kind of goes between 580 and 700. We sort of know how it works. Now, these 3 companies, they're going to give you a different credit score, but all of them should be very similar. So next we have a credit report, and I would like you to write down in your learning map what a credit report is. I essentially like to think of a credit report as your report card, as your credit score is kind of like your grade. Your credit report is like your report card. It's a bunch of things that add up together to tell how responsible you are with your credit. The things that make up your credit report are your payment history, the amount you owe, the length of your credit history, any new credit you might have, and the types of credit you use regularly. There's a company called FICO, and FICO is a company where you can find your credit report from all 3 of the credit bureaus. Now, something that you need to be aware of is anytime you are applying for a loan or even looking for a job, people can look up your credit report. FICO is a company that mortgage companies and commercial banks use to check how you are in your credit. So how you manage your credit is something that people look at, particularly your credit report card or your credit report. I love the way that this image breaks down credit reports. So 35% of your credit report, the biggest chunk, is your payment history, which is essentially saying, are you paying back on time? I think the most important thing you can ever do when borrowing money is paying on time. Remember, anytime you pay late, it will lead to a lower score, a lower credit score, that is. Next is 30% of the amounts owed, right? How much credit do you owe right now? If you're applying for a loan or you're applying for a job and you owe a lot of money, the way that you owe money or the way that you manage your money or manage your credit is a key part of your credit score and your credit report. 15% of it is the length of your credit history. How long have you had this credit card? Now, let's say you've opened 10 credit cards in the last couple months, right? That doesn't seem very responsible because your money is going in and out and in and out and in and out and in and out, multiple different places. How can you manage them all and be paying them all and be keeping track of them correctly? Let's say you have had one credit card for the last 10 years that you make a monthly payment on and you're really responsible about. The length of that credit history looks really responsible, like you care and that you've been keeping track of it well, as opposed to having a lot of short-term credit cards or a lot of credit. 10% is, have you opened any new credit lines recently? This kind of goes back to what I just talked about with the length of your history, right? If you have several short accounts, your credit score drops because it doesn't look very responsible. 10% is the types of credit you use. Do you have more than one credit line? Once again, going back to the length of your credit history, it looks better to have one credit card as opposed to multiple, but it also doesn't look bad to have multiple types of credit. Remember, credit is a financial tool. If you have multiple credit cards for just buying fun stuff, that doesn't necessarily look good. But if you have credit out for a car loan, and then you have a credit card out that you use for emergencies and a mortgage, these are productive forms of credit. These are things that you're using to help you in life. Having a car for transportation, having a home that you could potentially make money back on, right? These are improving your credit score. The types of credit you use, as opposed to having 3 different credit cards to 3 different retail stores where you don't buy anything necessarily productive. The type of credit makes a big difference. So, what is important between you and your credit report? First, check your credit report at least once a year. Make sure that you keep an eye on it. And make sure that those 3 different credit bureau numbers are similar. Like I said, check for accuracy. Check your payment history. You know what you've bought. You know what you've been using your credit for. Make sure that your credit score matches what you know and what you've been personally keeping track of. If you see an error, make sure you contact the company immediately. It doesn't hurt you to dispute what you see. If you think they've messed up, talk to them about it and try to fix the error. It's not going to drop your credit score. So, who checks your credit score? There are 2 types of ways that your credit score can be checked. The first one is a soft inquiry. Anytime you have a background check on your credit history, it's essentially looking and going, okay, how responsible is this person with their money? This gets done, for instance, when you apply for a job. It's not going to affect your credit score. They just want to see how you handle your money. It's just looking, not contributing. A hard inquiry is a little different. Now, hard inquiries do affect your credit score. Let's say that you've applied for 2 different credit cards in 1 month. Like I said, it's not really smart to apply for multiple forms of credit at once. It's better to have a longer standing history as opposed to a bunch of short-term credit cards. A hard inquiry is when someone wants to give you credit and they're checking to see how you handle your credit, how you handle what you borrow, so that they can decide if they want to lend money to you. Anytime that you apply for credit, a hard inquiry is made, and that shows up on your credit report for up to 2 years. And remember, the next person checking for a hard inquiry will be able to see the last time that you did apply. So remember, soft inquiry is running a background check just to see how you handle your money. A hard inquiry is when they're checking when you're applying for credit. Background check, applying for credit. Soft is a background check, hard is applying for credit. So, when is each type of inquiry made? I'm going to pause the video and explain these to you. Congratulations, we've made it to the end of direct instruction. So what I would like you to do now is tell me what the value of a credit report is. Or, in other words, how does your credit report and credit score impact your life, whether it's good or bad? Obviously, a credit report is a fingerprint. How does it affect you? I'll explain this a little bit more as I pause the video.